Unit 8, this is working capital management. Broadly, we are going to discuss these topics. Working capital management, liquidity ratios, cash management, marketable securities, receivable, inventory, and activity ratios. Before I start my lecture, let me give you what we are going to discuss. Working capital is in accounting is equal to current assets minus current liabilities. Now, first of all, we should understand what is current asset, what is current liability, then what is the concept of working capital. Current asset is anything valuable in your asset which useful life is less than one year. That is most starting from inventory, which is another name as stocks. Then we have cash, we have bank, we have receivables. Receivable could be of any nature. It can be a trading receivable and non-trading receivables. This is I'm talking you a general company structure. If it is a bank, then they will have a receivable also and the payable as well. So payable is any current assets or current liabilities are those liabilities which you have to set off in less than 1 year time. Any loan, short-term loan that you have taken, any overdraft, any running finance, anything for short-term period you have to settle in less than 1 year is your current liability. Now you see that if your salary is 20,000, your expenses are 18,000. So you are having 2,000 as a surplus. So you are in comfort, you don't have worries. Suppose if it is opposite, your expenses are 10,000, your salary is 8,000, you are in 2,000 deficit. So it's a point of worry. You can't sleep properly. You will disturb. You keep disturb, and you will try to make more money to make this deficit covered. Same with the companies. Companies has receivables, they have payables. Receivable from the customers, that you can say their income, and payments are their payables, you can simple word. In fact, in accounting, expense and income is different. But just to understand, in cash flow, they have inflows, they have outflows. And they have to pay the salaries, expenses, they have to do a lot of expense, then the money will come. Now suppose you have to pay your supplier 30 days, and your customer will pay you in 90 days. 60 days you have to put money from your pocket. Do you have that money or not? This is the question. So this gives you a concept of working capital management. What is working capital management? Is to keep sufficient cash with you for the short-term, day-to-day operational activities. This is the working capital management concept, that we have to plan how much cash we should have, how much, and how it will be settled. It depends upon your AP and AR functions, account payable and account receivable functions. Then if you have some fixed investment you want to do, you want to buy a new asset, your one asset suddenly stop working and now you need another replacement which require a huge cash which you are not ready for. If you don't have efficient working capital management. So first of all, we have to understand what is working capital management. We need to build up a system which should tell us that this is the minimum cash we should have. This is called permanent working capital that we require. For example, you come to this institute, you are coming on car, for example, and your car might get out of order, it get punctured, you need to eat something. So you should always have some minimum money in your pocket. If you don't have, you don't feel comfortable because everything you can't do on credit card, right? So you have a minimum permanent working capital in your pocket as a built-in logic. Same for the company. They should have a permanent working capital with them as minimum. And then one is above that, fluctuating. Means might be our car in this year need overhauling. So during the year we should have a cushion for that one. Then we need some fixed assets. Someone is going to marry, someone is going to have other commitments, this cash you have to plan your requirements. It may be you took it from loan, you took it from your personal savings. This is another thing. But we are talking about cash. We need cash to make our expenses. Now, one thing is very important, that is the operating cycle. What is operating cycle? Is you start from suppliers. Your supplier you have to pay supplier money. Suppose this is 30 days. Then shipment will come. Suppose we buy from USA, 30 days the ship will come. Then 5-7 days it will take to clearance. Then it will come in your warehouse. 30 days it will remain warehouse, right? So then production will start. 30 days again production will take. Then it will be in a finished good. So already 90 days plus 7 days has passed. 97 days has passed to get a ready product which is ready for sale. Now you will start your efforts to make sales. Maybe 20 days you take to make it sale. So 97 days plus 20 days, right? Then you will sell it maybe on 60 days credit, on 90 days credit. So it's a cycle of 136, 40 days cycle in which you need money. Money will come after this cycle. So if suppose you need 130 days and your supplier is giving you 130 days credit, no worries. Then things are okay. You don't need to invest. Even if the supplier you are paying it 6 months and receivables you are getting in 4 months. So it's an efficient, effective working capital management, which is you are trying to do, but on the counterpart, your supplier is also doing the same policy. So he will give you a tough time. He don't want to give you 6 months. He will say, no, pay cash, take it. Okay, 30 days. Let's build up volume. Buy more, I will give you more credit period discount. This is how we go. This is the efficient working capital management and operating cycle concept. Now, liquidity ratios there are sort of ratios in the accounts which we are familiar to see how the company is operating, financial health and performance. Like how a doctor check a person, he has a blood test, he has blood pressure, he has sugar test. So the reports comes and they analyze. Same way as a financial consultant, what we do is we take the financials of the company and we apply certain tests. These tests are called ratio. These we have to test from all angles, short-term angles, long-term angles. Short-term angle is when you are going to have you are going to see the short-term ability to pay. For example, if you take a loan from a bank 2 years, now you start paying your installment because out of that money you can pay the installment. How bank will check that you able to survive in the long run? Same way, we have to check this thing that short term and the long term. For short term abilities to pay the cash, we use liquidity ratios. We take the current assets, we take the current liability. Opposite to this, we have solvency ratio, which is not a part of this discussion because we are talking about a working capital that is for current portion of the time, day to day. When we talk about long term, that is another topic. So it's solvency. We see the long term ability to pay. Your gearing, your leverages, financial leverages, we check there. That depends upon long term assets and long term liabilities. But as an analyst, we should know the short-term abilities, we should know the long-term abilities to see all things in context. Also, we have to see the market share and profitability patterns. We have to see the reputation, which group this is, who is the owner, what is his standing. These are all to see this company is a AAA company. There is a long list for checking. Ratios is one of the basic mechanism from where you start. Suppose you go to a bank, they will ask you, okay, bring 3 years financial statement, trade license, this and this. You will give them, they have a software called spreading, it will make spreading, and it will calculate all these ratios which will keep continuing automatically. This is 2:1 ratio, this is 3:1 ratio. But you have to build up a logic, what this ratio stands for, what is its formula, and what is its utility, how to use it. Knowing the ratios is not a big deal. Where to use which ratio is the application skill you have to develop. Cash management is ancillary to this. I told you we should know as a company how much minimum cash we should have in the company. Then marketable securities is, we will understand what are the security and how to manage. Receivable is customer management, and inventory is the stock, what is the minimum stock, reorder level, when to, how much is the optimized stock, what is the minimum stock, buffer stock, these are all terms we have to read. And activity ratios to check your day to day, means you are efficient in making sales, your receivable days are how much, your payable days are how much, this is what we will discuss. I think the spectrum of the lecture is very clear. Now we have to see the details. Working capital is equal to current assets minus current liabilities. Current assets are the most liquid asset. They are expected to convert into cash sold or consumed within 1 year, right? Same like current liabilities. This is by the same token are the one that must be settled the soonest. Now there is a difference between British system and American system. This is an American degree. In British system, we show in the balance sheet, which is now statement of financial position. You show the stocks at the top and the cash at the bottom. In gaps in US is opposite. That's why he is explaining here that the current assets include in descending order of liquidity, cash and cash equivalent the top, marketable security, receivable inventories and prepaid items. So here I will link you with the difference because I am also well familiar with IFRS and gaps difference we will keep discussing. Current liabilities also, you will take account payable, note payable, current maturities, long debt, unearned revenue, tax payables in the opposite way. Now, try to apply a simple rule such as current assets should be financed with current liabilities. Means for working capital management, we should know whatever we have to receive, this should be arranged as to pay.
Correct.
Basic rule. Then some level of liquid assets must be maintained regardless of the firm level of activity or profitability. Whether you are doing some business, for example here in Ramazan, there is no activity in terms of corporate sales. In retail, obviously if you are working in Carrefour, you are working in other, it will tremendously increase. But as a general, Ramazan, if the corporate sale is nowhere, but the salaries are there.
Yeah, same.
So this we have to manage. This is the point that we should have a minimum cash. As the firm needs changes on a seasonal basis, temporary working capital is increased and decreased. So I will show you a graph. This is the permanent working capital, which is you should have for DIVA bills, electricity, for telephones, for all other salaries, staff expenses, entertainment, business promotions. This you should have as a permanent working capital. For seasonal, for temporary working capital, this depends upon your forecast. The sales forecast, the other market information dynamics, Christmas is coming for example. So you need to build more exhibitions, you have to build the short term, you can say, you have to acquire some places for your stalls to present. You need upfront cash to pay. So that will be above than this permanent working capital because this is an additional exercise which is seasonal and based on your needs and your demands and your forecast.